Good morning, it's William Jordan here. Today is August 24th and I wanted to talk to you just briefly about the recent stock market decline. There's been a lot of news recently about some of the things going on in China, how that may affect global markets, and as a result, or as one of the results, our stock market has declined significantly in the last 3 days. Markets back up a little bit today, and as I always say, no one can anticipate or predict accurately the short-term fluctuations in the stock market. So we don't know if the market will be back down further in the next few days, if this is the beginning of a bear market, or if this was just a brief correction, the market recovers and then hopefully continues to grow. What is important is that we stop and just briefly assess what's actually going on. What should we learn from that? What can we take from that? And what should you consider doing for your specific situation? First off, I want to briefly speak about China. China has been kind of the darling of the investment world for a few years. China's had phenomenal growth rates, which makes sense. You've taken an unindustrialized country and it's industrializing, it's turning into, or in the process of growing into a first world country. It's a massive amount of growth and a massive amount of investment that's taking place when that's happening, just as America and England and the rest of the developed world went through 1800s and early 1900s. However, there's one substantial difference, and this is the reason why I've never advocated investing in China specifically, and that is China is not a free market. China is not a democracy, China is not a republic, China does not have a free market for investment as we would think of it and know it. Many people tend to forget the fact that China is a socialist or communist country. They have a very different set of rules, and when things are going up, it doesn't matter what style your government is, it doesn't matter what approach the government takes and how things are handled, because everything's going up, and as they say, a rising tide lifts all boats. But where that makes a big impact is when we have volatile periods in any kind of economy or any kind of market. You have a socialist or communist government that potentially might just want to dictate, no, we don't accept the market going down. So what's happening? China is talking about or devaluing their currency. China can step in and take control of industries that may have been privately or partially privately invested in. My strong recommendation to any investors is stay away from China. It is not a place that you can reasonably invest money with the same playing field and the same level of expectations for how you'd be treated as an investor as in many other places in the world. And we have seen that in other countries where they have stepped in and nationalized different industries, where whether it's American or international investors have come in, invested substantial capital, and at some point the government basically says, thank you very much, we'll take it from here. And you have no recourse. So on the one hand, China is potentially part of what's moving our markets currently. But on the other hand, I would suggest, one, as a direct investment, stay out of China. Two, when things are volatile in China, China is becoming a major player on the world stage, has become the second largest economy in the world. And so things going on in China, just like when things happen financially in America, it can affect other places in the world. But we want to ask a question, and I'm focusing on domestic stock market investments just for this brief conversation. What is it that ultimately drives the prices and the values of domestic stock market investments? The ultimate answer is one thing, and that is earnings of companies. China could have a big problem, but if the earnings of companies in the United States are growing, that should be increasing the value of those underlying stocks. So we want to look at earnings of companies and the price relationship. And that brings me to really the main point that I want to stress right now. Whether it's China, whether it's the coming election, whether it's Greece, whether it's something else going on in Europe, wherever the issue is, one phrase I've always been a fan of, the issue is not the issue. In many cases, there's an issue that gets our attention, but that's really not the big issue. The big issue today is stocks are overvalued. Stocks in the United States are significantly overvalued based on any historical measure of value. You take the simple PE ratio, price to earnings ratio, stocks are in the borderline of what we call the yellow and the red zone of concern, because in an overvalued situation, there's a lot more room to fall if there's a problem, and there's a lot less room to grow if there's growth and opportunity. So we look at the stock market today and we say, irregardless of it's China, Greece, a slowdown in the United States economy, a change in the upcoming elections, whatever the causal factor ends up being, if something causes investors as a whole to stop and look at the stock market and say, is the stock market a good investment for me today, or is this something where I should be selling because the market's overvalued? We think the more attention to the markets, the more attention there is to the fact that stocks are overvalued. And whether it's today, tomorrow, a month, or a year from now, we are expecting a bear market sometime down the road, sometime over the next 2, 3, 4, 5 years. We look at that period of time and have a difficult time saying stocks are going to be a great investment during that time. Now remember how I opened this brief talk. No one can accurately predict the short-term fluctuations of the stock market. So stocks were overvalued through many years in the late 90s. Stocks have been overvalued before. Stocks will be overvalued again. That does not mean stocks immediately decline. So here's the question. The question is, what do you need to do based on what's going on in the markets today and based on what is going on in your specific situation? My first piece of advice, and I just have 2 quick comments. First piece of advice is take stock, pun intended, take stock of your situation and ask the question, do you have too much invested in US stocks and in stocks around the world? In many cases, when we follow a 6-year bull market as we have, the percentage of stock market investments in your portfolio gets out of balance compared to the other investments that you have. And if, for simplistic statements, let's say you started out with a 50-50 stock and bond mix, well, in the last 6 years, bonds really haven't grown at all, but stocks have almost tripled in value, so your mix is going to be dramatically different from where you started. It might be time to pull some money off the table and lower the amount you have exposed to the stock market. I would even consider, if you facilitate between a 30% and a 70% allocation to the stock market, with 50 being your average, now's the time I'd be going lighter on your stock market allocation, not heavier. Not because the market is down in the last few days, but because the market is overvalued by any historical measurements, and we have to expect underperformance in the future, not overperformance. The second factor that I would consider is get defensive with your stock market investments. If, to the extent you want to continue to keep stock market investments and keep money in the stock market, get defensive. And what do I mean by that? I mean, have a sell strategy. And what's a sell strategy? A sell strategy is essentially a specific set of events that would take place where you would say, this is where I'm going to sell, this is when I'm going to get out. Because my question to you is this: what is most important to you? With your stock market investments, is it more important to try to chase the last few percentage points of gain when the market's going up, or protect from losing when the market's going down? If you answered protect from losing, which is what my answer would be, you need a defensive sell strategy. We actually have and manage a defensive sell strategy where if the market is generally heading down, we're going to move out of the market and go to cash and wait to see what happens before we get back in the market when things have recovered. Your risk of doing that is you miss out on some gains because maybe you get out of the market and go to the sidelines and the market goes up a bit, you lost out on some gains. However, you know you've protected yourself from any kind of catastrophic events such as 2008. And while I'm not calling for a 2008 kind of event, no one can predict when those types of events will occur, and we can look at the stock market values today and reasonably say that a significant bear market, a 20, 30, even 40% decline would not be an out of the question scenario. So not being able to predict what's going to happen, I can't tell you exactly what to do, but what I can encourage you to do is evaluate your holdings and look for opportunities to reduce your stock market investments in general. And if you want to keep money in the stock market, be defensive and have a sell strategy with that. Beyond that, good time to take a look at your entire portfolio and consider stocks, consider bonds, and even consider what else you should be doing besides that, because bonds aren't the best place to go from a safety factor either. But that's a conversation for a different time. So I hope this has been helpful. I encourage you to have a great day, and I wish you all the best. Thank you.